Welcome, everyone. I appreciate you checking in on us and looking at our educational initiative. We have Alliant Financial Solutions and Christian Wealth Management are doing this together. And but just we'll introduce each of the speakers in just a minute. But I just wanted to give you an overview of we're all part of Creative Financial Designs, CFD Investments, in other words, and that's our broker dealer. And we are all work for CFD in the broker dealer sense. They're located in Indiana, but we all focus on biblically responsible investing, faith-based investing in our practice. So we've teamed together to come together for this presentation. So yeah, let me introduce the other speakers. I'm Doug Hanson with Christian Wealth Management, and then Kevin.
My name is Kevin. I'm with Alliant Financial Solutions, and we're all here in the basically broader Treasure Valley area. And I'll pass it off to Ryan.
You'll hear more from Kevin soon. I'm Ryan. Amicis. Everybody wonders how to say my last name. So the Americanized version is Amicis. The Italian is De Amicis. So there'll be a test on that later. Did you know that, Doug?
I was going to ask what the Australian version was.
I don't know that. Just to kind of highlight, go back to about CFD Investments. CFD Investments is our broker dealer. As Doug, I think, mentioned, Kevin, Doug, and I all use CFD Investments as our main compliance officer, I guess, essentially, where they're keeping us compliant with the state and federal laws. You guys may have heard FINRA or the SEC. FINRA is the federal governmental agency over the financial industry, and the SEC is on the state level. So CFD keeps us in compliance and keeps us in good standing with those laws. So that's a good thing that we have a compliance over us. So CFD Investments has over 140 advisors. Kevin says 142. So as of this recording, in 31 states throughout the US. So that's, again, to just show it, we're part of a bigger picture. You know, we hang Christian Wealth Management on our door. Kevin hangs Alliant Financial, but we're all part of CFD Investments, and we're part of a bigger picture outside of just our office here in the Treasure Valley. The headquarters is in between cornfields in Indiana. I started using that, and I like it a lot because there are cornfields right between.
Pretty true.
Both
Right.
sides.
Yeah. So in Kokomo, Indiana, and you guys are probably familiar with the Beach Boys song Kokomo. They don't.
Not that place.
Yeah, they're not talking about that. So, but it is a place you want to go, though. And CFD also manages about $4.5 billion overall. So again, part of a bigger picture, more than just our offices in the Treasure Valley. And we also have an office in Hollister, California as well. All right, moving forward. So that's us again. And then, okay, we'll dive into at least my part of the conversation today. Here are disclosures. Doug, comment about the disclosures?
These are exciting reading, but if you don't want to read it, this is for educational purposes only.
Well said. Okay, so we'll break down what we'll talk through today in these different levels: economic, political, and how what we're talking through impacts how we handle our finances on an individual basis, our family basis. This is the third time I'm seeing this picture. It's a little bit less funny this time.
I'm still smiling.
So
That'll still on backwards.
So the cow, maybe Kevin, you can talk about what the purpose of this picture
At
is.
least you didn't put a bull up there.
A bull, okay, sure. So I
The
guess,
value of the cow being the idea that you get two purposes out of it, because you can ride it and milk it.
yeah, exactly. So times are tough maybe with inflation for some of you. So maybe buying a cow will help save some money because you can get cheaper milk, maybe. And if you use it for transportation,
You get ice cream too.
oh, ice cream. So that's a humorous picture that I found. And then this is another one that I like. We all romance the idea of certain things, and somebody was thinking, man, the world would be a utopia if there was no inflation. So trying to think what this reminds me of. Reminds me of some type of movie or show, but I can't remember what it was.
Star Trek.
Star Trek, sure. Star Trek, Star Wars.
Space Odyssey 2000.
Oh,
I also feel like maybe the new Star Wars series, Obi-Wan, maybe. Okay, so these are humorous ways to kind of shed light on the fact that things cost more money, and most of us, it's agitating to see the cost of gas going up, the cost of eggs going up. So these are pictures taken for the end of 2022, and gas prices are still high. I think they've come down a little bit, but I know egg prices have kind of come back down, but these were two sore subjects at the beginning of the year. And I know gas prices continue to be high. So when we think about inflation, so those last four pictures we looked at, all kind of shedding light on the word inflation. Inflation is generally measured by the CPI, which is the Consumer Price Index. And inflation essentially is the average cost of goods go up over time. Deflation would be the opposite if the average costs of goods go down. The CPI index is made up of these different 8 categories. So housing, transportation, food and beverages, recreation, have been thinking about, yeah, I know airline tickets are more expensive, gas is more expensive. My car insurance, I think, stayed the same. My food costs have gone up, but I feel like you're going to say something, Kevin.
I was just, it's a weighted average, so the housing portion of it's a bigger portion than the apparel portion would be.
Yep, that's a very good point. Yeah, so it is a weighted average, and the numbers are dynamic, so it's not at a fixed percentage. It's supposed to most accurately represent a household's budget weight on how much is spent on housing versus apparel. So again, these are the 8 different categories. It's weighted, and the number is dynamic over time. So what has inflation looked like over the last 100 years? This graph does a really good job of shedding some light on what is normal for inflation over a century. So if we look at this graph, what I've been looking at is, I think you guys can see my cursor, but if not, I can zoom in. This is good news. So this would be 1990 over here. 1992 would be right here in this cursor. So from here on, I'm born in 1992. That's why I'm finding this year. From here to here, this is what my experience in life has been about how inflation works. The last 3 decades have been very minimal fluctuation, what inflation deflation looks like, until 2021, where we saw the average inflation increase over 5% year over year. If we look through beyond or before maybe 1990, I should say, the volatility of deflation versus inflation, man, those spikes. What's the opposite of a spike? The declines. They're much sharper. Any notable time frames in there that you guys want to bring up?
Well, go ahead.
The 70s and 80s, obviously, a lot of confusion between the Carter era and the Reagan era.
Yeah.
High inflation and challenging. Your chart goes back, obviously, pre-1940. I would assume that's maybe the 1930s. There is the big deflation there.
Yeah.
So.
Yep. What we're seeing in the 30s over here is before 30s is the Depression right here. If you guys can see my cursor. Any dates you want to point out, Doug?
Yeah, no, kind of echo what Kevin said. I was born in 59, and so I was college at the high inflation of the late 70s and 80s. I remember the oil embargo, oil gas prices and long lines, and so I've lived through that. But it's even living through that, I got used to the last 20 years of pretty steady inflation.
Somebody mentioned that one of the live ones that we did, that there was odd even days for people, so you couldn't get gas.
Yeah.
Dude, I don't know. That was really interesting. I never heard that before.
I just remember along the lines of the gas pump.
Okay.
Yeah, and I think different ways to try to solve that.
Yeah. So this is again just showing a really long-term picture of what inflation has looked like. And for me, my takeaway is, yes, the last couple of years have been painful and have been abnormal from what we've experienced the last few decades. But in the whole scheme of it, the whole picture of the last century, it's not totally abnormal. Let me see. How do I move? There we go. Okay, and this is kind of the year over year, again, highlighting in 2021, we saw a 7% inflation rate. 2020 was only 1.5%, so it surged from 1.5% to 7%. And then in 2022, 6.5%. And then year to date, we're at like 3.6%, maybe 3.8%. So again, things have spiked up the last couple of years. Things are getting a little bit more in hand, under control now, but still the last few years have been abnormal from what we've seen in the more recent history. So this kind of was even highlighted in the long-term inflation graph that we saw. But in 1980, we saw inflation was higher. But here, this is mortgage rates. If 1980, if we remember, I don't remember actually. This is just remember based off of reading and hearing things, not from personal experience. But I have heard that people had really high mortgage rates in the early 1980s. My mortgage rate's 3.5%. And a lot of people have like 2%, whatnot. So to think about mortgage rates being over 15% is absurd. To think about how much interest I'd be paying on my mortgage, but that's what we've seen in the past, and that was, I would say, in the more recent history. And we are seeing a surge of mortgage rates going up. It's over 5% for most loans right now. But when we look at the average, we're still kind of cruising maybe around the average historical interest rate. So I know a lot of our clients, if we're working through the baby steps, part of going through the baby steps is saving up to buy a home. That's baby step 3B. And by baby steps, I mean the Dave Ramsey 7 baby steps. So baby step 3B is save for a home. And I know families that are trying to save for a home and are discouraged right now by higher interest rates. And so that is a challenge of where we're at right now in this moment in time. So we talked through inflation briefly, mortgage rates, and then this is unemployment rates. So this graph's interesting or encouraging, at least for me to see that, over the last 2 decades since January 2003, unemployment rates right now are at a low. We saw a surge in 2020 mid-pandemic. Saw a surge obviously after the financial crisis of 2008. So my takeaway from this is to have low unemployment rates means there's lots of opportunity for work, or people are at least working. And for people to be able to be in a position that they're working, they're bringing in income to their household is an encouraging note. So I don't know if you guys have thoughts to add to this. So there's different perspectives that people can talk about with unemployment rates being low. One of them just being, if unemployment rates are low, that means there's a lot of competition for businesses on employees, on how to retain an employee. And yeah, that causes challenges. But I think a silver lining is the fact that people in a household has opportunities to bring in income to buy things that are necessary, like gas, food, clothes, shelter. That is an encouraging note. All right, Kevin, your turn.
So you want to zoom in on that like you did on yours just a little bit?
Yes,
Because
I'd love to.
this is kind of an intriguing chart for me. I really appreciate having this available because it shows this is kind of the we come up against some world event or some national event, and the question is, what about tomorrow? None of us has a crystal ball, but the opportunity that this chart offers is the idea that when we have these economic events, it's not the end of the world. In fact, the chart shows that the markets continue to positively respond after they've experienced whatever shock occurred. So you've got events, in the beginning, things like the what do we got? Korean War at the very lead of it. Post-Korean War recession, you move into the Nixon recession, Kennedy slide in between places, Black Monday, Gulf War, all of these various events. And as it's moving across it, the stock market experiences some form of shock because of the fact that it's adjusting to its current tension, and then it returns to normal. One of the things that I make a point of highlighting for the live events when we're talking through that, we had a client that came to us asking about what would happen with the tensions in Ukraine. And I always like to remind everybody that, when World War II is occurring, you've got, 1939, 1941, various events, business still had to go on. People are still buying gas, people are still buying clothes. And when you're invested into the stock market, what your return is based on is the fact that the business that you're buying through mutual funds, ETFs, or individual stocks is based on the idea that the company is producing something, and that return is what's making the stock market go up. So even when we're having a war in Ukraine or a 2020 event, we're still going to see the stock market participation continues because the businesses are still doing business. So
I forgot. I remember Kevin likes to do the slides himself, but that's not a luxury you have today.
not today, no. Yeah.
There we go.
So this slide is the average market returns during presidential term. This slide and the next one both are highlighting the idea of what's happening over the course of a 4-year series of events. This one, we can make a point of highlighting the midterm, but just thinking about the idea of the various events that occur through the market cycle of the 4 years. This is weighted averages over the course of a number of market years, not necessarily the last 4 years or the last 8 years. It's going back over the course of years. And we see that just generically speaking, on a midterm election year, you've got a lot of volatility that occurs because the markets don't know what's going to happen, what's going to change in the House or the Senate.
Yeah, keep going. That's the Bluetooth speaker. Don't worry about it.
So we don't, the markets don't like instability. So there's a dip that occurs in the second quarter because they're doubting what's going to happen next. And then right now we're in basically the third quarter of the third year of the presidential term. And that kind of gives us a picture of the idea that we're going to be in some volatility over the course of the next 18 months or so while the markets watch what happens through the presidential election process. You see the average first quarter is not so good, or this is market returns. Yeah. So average first quarter is not so good, but second quarter's back up again, third quarter's down, fourth quarter's up.
Fourth year, yeah.
And that's kind of what we should be expecting, the level of instability that might occur next year. The next slide is going to show the volatility, and that's similar sort of statements, common concerns. You'll see that, like I was mentioning with regards to the midterm elections, the volatility really spikes through the second and third quarter because it's just a lot of unknowns. But right now we're in the third quarter of the third year. And so we can see the idea that it's up and to the left right now, up and to the right, up and to the right. I do that every time. Up and to the right. I don't know which way is which. And then into the middle of next summer, it could be maybe lower volatility and then some volatility that we'll experience as we're going into November of next year. With, again, you could slide back to the other end of the screen that the volatility could drop in the first part after the presidential election. So looking into next year, we should expect some level of volatility going into the first part of the year, especially as the markets are asking questions about the presidential process.
Yeah, and it's showing too, you may have said this, but that from here until the beginning of next year, the
Yep.
increase in volatility, and we've seen that in the markets today.
Yep.
So
This is I have to look at this chart every time I look at it. But this is the expectation of the market's return in the years following the presidential process. So midterm election years have the best rate of return in the year after the midterm elections. And in the year after the presidential election is a good year, and the other years, so 2 other years, first year and third year, or it'd be second year and fourth year, have the lowest anticipated returns. And that's really the truth of this chart, is the fact that the previous years, so the year before the midterms and the year before the presidential election, is more volatile. So these returns are greater because of the fact that you've had the market instability in those years before that. So again, going back to that very first chart, the reality is the fact that the market continues to experience fluctuations and readjustments, and then it adjusts up and to the right as it does, because it's built on equities.
well, Doug, do you remember what happens next? Wow, there we go.
So we've heard a number of things: inflation and presidential elections cycle and mortgage rates and unemployment, and we can't control those things. We live in them and through them, but so we need to focus on what we can control and invest accordingly. So as this chart shows, our goals, we need to make sure we understand what our goals are for investing, long-term, short-term, and once we've defined those, thought through those, settled on those, then those should drive our investment choices, because our investment choices from the risk tolerance perspective, the type of investments we choose, we invest in, should relate to our goals. If they're not connected, then that can be a challenge, a problem. So our investment choices should be based on our goals, and then working with someone like financial advisors like us, others, professional partners, really help you think through and hone in on what the best investment choices are for your goals. And then as your goals change, we work with lots of folks and we meet with them, and then another meeting, there's something that's changed in their life, and so their goals may have changed. And so let's talk through how that may impact the investment choices you make. So to work with a professional partner, financial advisors, to continue to help you think through that. The other thing that as financial advisors we can do is we can help you not make decisions on emotions, because our emotions will drive our thoughts. And as Kevin mentioned, the war in Ukraine brought up emotions or thoughts from people that were invested and wondering what's going to happen and should they stay invested and things like that. So it helps us as well as financial advisors. We can help you think through and kind of stay focused. And again, as the chart you saw earlier, the market always goes up to the right over time, despite its different fluctuations, adjustments, corrections due to circumstances. So let's focus on what we can control. This next chart shows kind of one way. I guess before that, this is kind of just a simple chart of the market. Looking at it on a day-by-day basis, the market goes up and down. And if you look at it over decades, the market goes up over time. So we want to focus on the longer term in investments. So this is approach we like to use with folks, having 3 buckets. The now bucket for Dave Ramsey fans, that would be your emergency fund, and that would be 3 to 6 months savings. I know with retirees, some of them like to have longer year of savings in there to weather the storm or unexpected expenses that they may have. So have sufficient liquidity in the now bucket is important. And again, that kind of depends maybe on your situation and stages in life. Then the soon bucket, this is where it need the money, and if maybe just in a few years down the road, you don't want to invest it very aggressively. You want to limit your downside risk, as it says. And so again, this is the time frame, what your goals are. You know, perhaps if you're saving for a house in that one and you want to buy one in the next few years, there's certain investments you may make, certain risk tolerance you would try to achieve in that. And then the later bucket, this is for a number of years down the road. This is where you can be more aggressive usually and let it grow, let the market work for you on that. And I know from my experience, even in retirees, it's important to have this later bucket because you know, the Lord may not take you home for 20 or 30 years after you retire. And so you may have healthcare issues, may have leaving inheritance, you'd like to do that, maybe generosity goals you have. And so that later bucket needs to be part of your planning, your investing, you know, I think no matter where you are in life. So we like to work with folks on these 3 bucket strategy, and really helps fine tune the investments for what the goals of the person is.
So as I figure this out, Doug, do we talk about within the investment choices like that we focus on biblically responsible
We
investing?
did not talk.
We did it.
Yeah, you want to talk about that?
I just like how you talk about it.
Yeah, well, I kind of mentioned at the very intro, but yeah, at Christian Wealth Management and Alliant Financial Solutions, we do focus on faith-based investing, biblically responsible investing, investing according to your values. And so that's one thing that kind of sets us apart in that. So we really want to work with you on that. And we work with a number of different investment firms that focus on that. They create mutual funds after they screen the companies they invest in. And they look at them not only from an avoiding standpoint, let's say companies that make money off of abortion or pornography, but also looking at companies that are really doing bringing blessing to the world, doing good in the world, doing products that are improving people's lives and stuff. So when we talk about moral investing, faith-based investing, we have both this negative and positive aspect of a screening aspect, but also a blessing aspect. Yeah, that's what we all focus on in our practice. So yeah, that's good to bring that up. Our goal from Alliant Financial Solutions and Christian Wealth Management is to stay connected to you. So we go to weekly newsletters, emails that go out. We have websites, informative websites, social media, Facebook and LinkedIn. And then there's 3 symbols at the bottom. I'm familiar with the one on the left and the one on the right.
Instagram.
The one in the middle, I'm not as familiar with, but I know it exists.
And we don't use it.
Yeah, we don't use it. We just like the picture. I don't know. No, but anyway, we try to keep up with you. So if you're not getting the weekly newsletter, reach out to us. You want to be able to know how to access our website, and you don't know, reach out to us. And then again, follow us on Facebook and LinkedIn.
I know on our website, you can just go to our website and we'll give you a spot to sign up for the newsletter.
Yep.
And same for you.
Yep.
Great. So, yeah, thank you for listening to us talk about our perspective on the market and what we have going on. And I hope you guys have a wonderful rest of your day.
Thumbs up.